They were looking at the end of the second quarter Basel III US compliance, whether it will or will not, and what it will or will not have on gold. Actually, this is the top question right now. And just as we experienced ahead of the 1st of January 2023, Basel III, global FX market compliance, and never forget, the LBMA's protestations leading into it. They went berserk, saying we don't need it. And we're once again encountering a lot of deliberately planted skepticism around the US phase of this compliance process. So further to what we looked at in our last episode, which I think created a lot of questions, I'm going to feed back what we and every single first-tier liquidity provider are gearing up for, because that's where the whale footprints are. Now, while full implementation of Basel III is being delayed in Europe, most of the Basel III package, including, this is important as it relates to gold, has already been adopted in the EU, whereas in the US and the UK, where implementation remains incomplete or paused. We'll deal with all those questions. However, there are three main drivers. Let's just start with the three main drivers that will force global Basel III US compliance. And yes, spoiler alert, China is capitalizing on all this foot dragging that's going on. So first and foremost, allocated gold held in all global vaults is already fully Basel III compliant and meets the standard of both a high quality liquid asset and a first year asset. Now we'll deal with non-compliant unallocated gold shortly, but secondly, looking at the three real major reasons here, the US Treasury has an upcoming gold audit schedule to ensure that the 8,133 tons of vaulted gold, which is supposed to underpin the Treasury's gold revaluation account, the GRA account, has to be Basel III compliant. Otherwise, it wouldn't comply. And that not only means undertaking a physical bar audit of allocated gold, but also to determine clear title, which is a very important component of that audit. Thirdly, while COMEX and unallocated gold is not NSFR compliant, the exchange for physical mechanism, that's the COMEX backdoor facing the NSFR compliant foreign exchange markets, directly link into allocated gold. As a result, the EFP mechanism is slowly, systematically letting the air out of trillions of dollars of asymmetrically imbalanced Fed-centric bets against gold, largely constrained really to how much of this open interest, the chips in the casino, that can be offset against a shrinking supply of actual COMEX speculators. Now, this process is evident by the series of shrinking supply of speculators, but it's evident by a series of higher physically supported stair steps, forcing the Fed to repatriate gold and pay back Bank of International Settlements bets at a series of higher prices. Furthermore, as we outlined over the last few episodes, Chinese and Asian facing fully allocated physical kilobar markets are 100% Basel III compliant and physically deliverable, with these real, undiluted supply-demand prices increasingly competing with non-Basel III compliant gold. Here is the latest, and note, the upcoming fully compliant Basel III Tier 1 to compete with a spot contract, to compete with and highly influence the local London fixes. And I say spot, setting a spot price that is deliverable, fully allocated with the gold. And just read that, the gold is there.
It's no exaggeration to say we're in the final innings of a system that was never built to last. A system built on promises, paper, and leverage is now being confronted by something far older and infinitely more durable: gold. And not just any gold, but physically allocated, Basel III compliant gold, now emerging as the ultimate arbiter of financial truth. For decades, the LBMA and COMEX ecosystems thrived on a fractional reserve model that was never designed to accommodate this shift. They built a pyramid on unallocated gold, IOUs upon IOUs, treating the illusion of ownership as ownership itself. But that game is ending. And let me tell you, the unwind isn't going to be polite. It's going to be structural, it's going to be global, and it's already in motion. Whether Wall Street wants to talk about it or not, we've moved into a deliverable pricing regime. Paper claims don't count anymore. If you don't own the bar, you don't own gold. That's the simple truth. Now let's talk mechanics. The LBMA's unallocated gold scheme has long functioned as a source of hidden leverage, a fractional reserve shell game. Bullion banks could sell the same ounce of gold a dozen times over, confident that only a small fraction of clients would ever demand physical delivery. It worked beautifully, until Basel III. Once the net stable funding ratio, NSFR, kicked in, that entire framework came under fire. Suddenly, those banks couldn't treat unallocated gold as Tier 1 capital anymore, and that forced a choice. Either source the physical metal and allocate it with clear title, or take the capital hit. Unsurprisingly, most of them have chosen the latter. The result? A massive divergence between the paper gold price and the physically settled spot price in the global FX gold market. What's particularly interesting and revealing is how China has handled this transition. While the West continues to drag its feet, complain, delay, and study Basel III compliance, China is already playing the next game. They've effectively forced the issue by using the FX gold markets, particularly through the Shanghai Gold Exchange, to demand physical allocation. And they're doing this at the global daily fixes. That's the real battlefield now. Forget COMEX, forget ETFs. The global benchmark for gold is quietly being reset in Asia, and it's happening bar by bar. At these global-facing fixes, the gold must be deliverable. The price must reflect physical reality, and any discrepancy between the COMEX-generated paper price and the deliverable spot price is instantly arbitraged. It's pure alchemy, the West paper claims being converted into Asia's vaulted metal. And the funny thing? The LBMA can't do anything about it. They're still clinging to old narratives, claiming that haircuts on unallocated collateral are manageable, that liquidity remains robust, that confidence hasn't been lost. But the market sees through it. The unallocated gold is being drained faster than they can plug the holes. And the smart money, the liquidity providers, the central banks, the sovereign buyers, they've already moved. They're reallocating away from unallocated structures and into real, fully allocated positions. Why? Because Basel III changed the game. This isn't speculation, it's regulation, it's compliance, and it's being enforced not by headlines, but by physical delivery at the fix. There's also the not-so-small matter of the U.S. Treasury audit. Most people haven't even heard about it yet. But make no mistake, it's coming, and it's a big deal. The U.S. Treasury holds 8,133 tons of gold, or claims to. That gold is booked on the balance sheet at $42.22 per ounce, a price last updated during the Nixon era. But here's the problem. If the U.S. wants to maintain its gold revaluation account, GRA, and meet Basel III compliance, that gold has to be audited, physically, bar by bar, and not just for presence, for clear title. That's the catch. Because if any of that gold has been leased, swapped, or encumbered in some derivative scheme, it no longer qualifies. And that opens the door to one of the biggest accounting events in monetary history, the revaluation of sovereign gold holdings.
So really, in summary, what the LBMA are trying to spin now is that unallocated gold held as a collateral amongst the clearing banks is subject to a haircut, while ignoring completely gold-facing central bank and institutional demand at the fixes is allocated and deliverable. And what's happening is draining unallocated gold out of the system faster than the LBMA can cover their imbalanced, over-collateralized positions. You've got all the data there. You've got the bullion bankers explained. It's clear as a bell. China is already doing Basel III work by way of alchemizing the West's non-compliant unallocated gold and forcing delivery at the fixes. So this kind of brings us on to US compliance, which is really where we've seen a lot of skepticism. The US Treasury has an upcoming gold audit to ensure that the 8,133 tons of vaulted gold that populates the GRA account, the gold revaluation account, is Basel III compliant. It has to be. So summing up Harry's question, just as there was skepticism around the bullish for gold price appreciation ahead of Basel III in January 2023, there is similar skepticism that US Basel III compliance will influence gold at this time. But just like last time, the skepticism is entirely US-centric, failing to look at what has spilled over into the technically NSFR compliant FX and short, the FX, the technically NSFR compliant FX short OCC positions. They have to be covered. And the upcoming US Treasury gold revaluation from $42 to an average of what the current bullion banks estimate is going to raise well over $1 trillion, but it has to be completed ahead of the necessary upcoming audit, where Basel III compliance would be required for the US Treasury to exercise its GRA opportunity to revalue gold to market. And it's far better to buy back lease swap gold right now in the 3,000s than at 4,000 or 5,000. So what really counts is at the global facing fixes. I have to really underscore at the global facing fixes, the Basel III compliant fixes are in full first year NSFR compliant and are forced to be deliverable. Any discrepancy between the COMEX generated paper market price and the physical price is immediately being alchemized. Hence, the ever-tightening Asia buys, West sells, noose tightens on the mispriced Western markets. So to answer Harry's final part of the question, there's nothing to front run. The LBMA's already done their utmost to pull bids and sell the news. One only has to look at the lack of Western market participation to evidence that. You can see it in this link.
And here's the crux of the matter. Whether you're a central banker, bullion bank, hedge fund, or retail stacker, the game has shifted. Basel III isn't just regulatory theater anymore. It's a structural transformation of how gold is valued, collateralized, and ultimately delivered. In China, with its deep understanding of this shift, is setting the tempo. While the West hesitates, caught in its own web of unallocated contracts and paper gold gymnastics, the East is stacking, kilobar by kilobar, at a pace that reflects the real geopolitical weight behind gold. It's not some abstraction on a spreadsheet. It's about sovereignty, about exit ramps from the dollar, about a fundamentally different settlement mechanism being established beneath the noses of Western financial elites. Let's not kid ourselves. Every time we see the EFP mechanism drain COMEX open interest, every time there's a mismatch between the LBMA's paper fix and what the Shanghai Gold Exchange settles in actual physical gold, we're seeing an alchemy in real time. That's not theory, that's the new architecture. And as liquidity providers have been warning for months, the spread between ETF-based, haircut-heavy gold and NSFR-compliant, deliverable spot FX gold is going to collapse into a single reconciled reality. And it's going to be dictated by the markets that demand physical allocation, not by London, not by New York. And it's not just a matter of interest among bullion banks. Sovereign players are now taking gold seriously again. Take the BRICS expansion, nations like Saudi Arabia, Egypt, and even Argentina expressing interest. These aren't just regional players anymore. They're resources powerhouses, and they're making it clear they don't want to settle oil contracts in unbacked green paper. They want real assets, settlement instruments that don't come with a counterparty risk labeled Washington, and gold, allocated, audited, revalued gold, is rising to fill that role. Now let's take this one step further. What happens when the US Treasury, facing an audit, realizes it needs to revalue its 8,133 tons of sovereign gold to reflect a Basel III compliant framework? That's not an if, by the way, it's a when. That audit isn't optional. And the very act of adjusting that gold from a 1970s price of $42.22 to something even remotely resembling today's market rate, let's say a conservative $3,500 per ounce, injects over $1 trillion into the GRA account. That isn't a conspiracy theory, that's math. And with Treasury bonds hemorrhaging trust in buyers, that kind of recalibration might be one of the only palatable ways out of a debt spiral without triggering immediate dollar collapse. Of course, some will scoff. "That's crazy, Andrew," they'll say. "The Fed would never allow it. Too inflationary, too destabilizing." But let me ask you this. Is it more destabilizing than $2 trillion in annual deficits? More destabilizing than the Treasury market losing its safe haven status while the Federal Reserve continues to jawbone about price stability? The system is already destabilized. The repricing of gold is not the cause. It's the symptom of something much larger unraveling. The real question is how long the illusion of control can be maintained. And then we get into the technical side that Wall Street doesn't like to talk about, the COMEX. Folks, the COMEX is not a physical market. It never was. It was always a leveraged casino for directional bets. What changed post-Basel III is that now, through backdoor EFP flows, that casino has been chained to real settlement markets. That means every time COMEX sets a price far below what NSFR-compliant spot markets would clear at, there's a drain, a bleed, a conversion of mispriced paper into physical. The game of spoofing and wash trading has run its course. Why? Because now those trades are being arbed not by other speculators, but by liquidity desks linked to physical bar flows. The arbitrage isn't theoretical anymore. It's happening. Just look at the open interest in the COMEX futures book over the last 18 months. It's not just declining, it's being structurally dismantled. When the open interest stays stagnant while gold prices explode higher, that tells you the price is being driven by outside forces who don't care about margin calls or gamma squeezes. These are sovereign buyers, long only, delivery seeking. And when the demand for physical delivery at the global fixes, especially the morning London fix, starts consistently outstripping allocated supply, well then you have the tightening noose that I keep referencing. And it's not just me. You don't have to take my word for it. Just look at the Bank of International Settlements' own documentation. Their gold swaps, once hidden in footnotes, are now being quietly wound down. Why? Because the cost of maintaining these synthetic hedges is becoming untenable when weighed against a gold market that is structurally repricing to reflect physical reality. What does that mean in plain English? It means the central banks are running out of excuses. You can only sell forward so much metal before you start running into your own collateral walls. And it's not just central banks. The LBMA has been caught flat-footed. Their own clearing statistics, published on a delayed basis to minimize panic, now show a dramatic shrinkage in unallocated balances. That's not a fluke. That's a result of Basel III implementation colliding with the physical markets. For every 1 bar being bid for at the London fix, there are multiple counterparties fighting for priority. And when that happens, guess what? Margins blow out, settlement times extend, and premiums spike. That's not a market functioning well. That's a market being drained. Now, I want to talk briefly about what's coming in Q3 and Q4. If the COMEX doesn't start aligning its price with the 10 times larger deliverable spot gold FX market, especially in Asia, then the EFP bleed will accelerate. What does that mean in practice? It means we'll see record conversions of paper to allocated physical. It means you'll hear more and more whispers about phantom bars, about delays in settlement, about premiums on even good delivery gold. That's how the system collapses, not with a bang, but with an unfillable order book. And I don't care if you're a macro hedge fund or a retail buyer with a shoebox full of coins, the dynamic is the same. If you're holding unallocated gold, ETF gold, or COMEX futures thinking you're protected, think again. The only defense against this structural repricing is physical allocation. That's not a slogan. It's a survival strategy. You can't play delivery games in a world where counterparties are being margin called in real time. Now let's lighten it up a bit. I saw a meme floating around the other day. Picture of Powell with the caption, "I swear we're not monetizing the debt." And underneath it said, 3 trillion printed later. It's funny because it's true. The Fed is stuck. They can't raise rates without imploding the bond market, and they can't cut them without lighting inflation on fire. That's why gold is rallying in both directions now. Whether the Fed hikes or pauses, the underlying truth remains, They've lost control. You want to know who hasn't lost control? China. Not because they're economic geniuses. Frankly, their debt situation is worse in some respects. But because they play the long game. Every ounce of gold imported into China is part of a broader exit strategy from the dollar-based settlement system. And as that gold flows in, they're exporting deflation to the West by draining physical supply. The more COMEX bleeds to cover deliveries, the more Asia tightens its grip. This isn't just economic warfare, it's strategic asset realignment. Now, if you're sitting there wondering, well, Andrew, where does that leave us? The answer's simple: ahead of a reset. Not a monetary reset in the textbook sense, but a functional reordering of value perception. The world is going to reprice gold. It's already doing it, but most of the West hasn't noticed yet. When the discrepancy between COMEX and the global spot FX price becomes undeniable, the repricing will be instant. Gold won't inch higher. It'll leap. Gaps, not steps. And in that moment, the crowd will realize what the whales already knew. Deliverable gold is tier 1. Everything else is an IOU. And finally, let's talk psychology. Investors have been lulled into believing that gold's price is what COMEX says it is. But ask yourself, if the majority of global gold trade is settling in Shanghai, Dubai, Istanbul, and Zurich, where allocated delivery is the standard, why would a New York-based futures contract be the global benchmark? That question is now being answered in real time by markets. The answer is, it won't be for long. This is the time to act. Not tomorrow, not when CNBC finally admits gold is having a moment. That's when the window closes. Right now, as the EFPRB drains mispriced gold from Western paper contracts into compliant spot FX positions, you have an opportunity to front-run the central banks, to beat the institutions, to hedge your portfolio with real, deliverable assets that can't be rehypothecated 10 times over. That's not just smart, that's survival finance. Because as I always say, when you hold physical, you hold the truth.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.